Hi, I've been successfully investing in income properties for over 25 years now. Over the years, I have developed a method that helps me to quickly analyze real estate properties and determine their level of profitability. In this video today, I would like to share with you my automatic investment analysis method. By the end of this video, I hope to provide you with a little more clarity on the things that need consideration when deciding on an income property purchase. So let's get started. Okay, so this is the chart that I use, and I will walk you through some of the basics. Remember, we're looking at levels of profitability. To determine this, there are a number of different factors that we need to know. One of them, of course, being the purchase price, which in this situation, we've determined to be $300,000. The second, of course, being how much rental income can I get? And so in this particular scenario, in this example, we've got $1,850 per month as rental income, which gives us $22,200 annual income. I do have vacancy and collection loss at 0%, and that's because right now in the market, it's very hard to find a rental, so you should never have any kind of a vacancy loss that you're looking at. So now the third thing that we want to look at is the annual operating costs. And when looking at those, we have to determine a few different things. One of them is the property taxes. So in this one, we've got $1,014 that we put in for the annual property taxes. Now, for the strata fees, we have $2,640, and that's because the strata fees times 12 months, it equates to $2,640 annually. We didn't put anything in for management, and that's because it's self-managed, and it is possible to self-manage your units and not have to pay anybody. So now with maintenance, we did put in 500, and that's because if something breaks down, any kind of an appliance, or if there's a problem with the locks, anything at all, we're going to need to pay somebody to fix it for us. And therefore $500 is a very safe figure to put in there. So now moving down from that, we figured out what the annual operating costs are, and we've got a total of $3,654. So we move on from the annual operating cost into the mortgage. So what we need to determine now is, what is the mortgage amount? How much can I get for a mortgage? How much of my own capital will I be investing? And so in this scenario, we're looking at $270,000. We're hoping to be able to get that amount for a first mortgage from the bank. And if we can get an interest rate of 5% and an amortization of 30 years, then we'd be looking at monthly payments of $1,440.96 monthly. So now we take that figure and we go up to our debt service up here. And this is the monthly cost times 12, which gives us $17,292. So essentially what's happening is we've got our operating income of $22,200. We've got to take out our expenses, $3,654, and then now we've got to take out our mortgage payments of $17,292. So over the year, now that leaves us with $1,254 left over. So that's called our cash flow. What's nice about this property is that it does at least cash flow. We don't have to put any of our own money in to keep it operating. That we can rely on the rental income from the tenant, and that covers our mortgage payment. We've got a little bit extra left over, about just over $100 a month. And then the other thing that's happening here is that we're going to be paying down our principal. So our principal reduction at $4,020, if we add that into our cash flow, we've got a total return here now of $5,275. When we make this mortgage payment of $1,440.96, we're looking at paying partly principal and partly interest at the 5% interest rate. So the portion that goes towards the principal, that totals $4,020 over the year. We know this only because of this system that I've developed here. It calculates all of this stuff automatically for us. As long as we put in the numbers, like I said, the 300,000 for the purchase price, we have to put in this number here, the 270,000 for the mortgage amount. We do have to put in the interest rate and the amortization, so we have to know those two figures as well. We do have to know the rental rate of 1,850, and then on top of that, we do have to know what the property taxes are, the strata fees, and then, of course, we make an estimate at the maintenance. So these are the figures that we have to know. And if we know those numbers and we can plug them all into this system here, we now will have it self-calculate for us all the different things that we need to know or that we would like to know. And so now, basically at the end, we can see here that we have a total return on investment of 18%. Our cash flow is 4%. So at an 18% return on investment, it's a nice, safe investment. It's a good return, and the investment is safe because it's real estate. And one last thing I would like to note here is that this 18% is based strictly on the income from the tenant. So we're not including the increase in property value that takes place year after year. And so if we were to include that, this would go up really quite substantially, this return on investment. But that, again, is for a different, it's a different topic, it's a different consideration. This is strictly to compare one income property to another to see the level of profitability, and then at that point we can decide, which one do we want to go with, which one is the winner as far as us making a decision on our investment. Okay, well, thanks for watching my video, and thanks for joining me in this spreadsheet and this analysis, and I hope to see you in the next video.